Hey there, welcome to True Market Finance. I'm Steve, your modern-day wealthy barber, here to cut through the financial noise with 2025 wisdom. In this series, we're exploring why savings accounts are falling behind and how Bitcoin, now past $89,000, can pave your way to real wealth. From small steps to dollar-cost averaging, I'll show you how to save smarter. So, take a seat, hit subscribe, and let's grow your future, one Bitcoin at a time. Chapter 1. The New Rules of Wealth, From Savings Accounts to Bitcoin. For decades, traditional financial wisdom has pointed to savings accounts as the foundation of financial stability. People were encouraged to stash away money in the bank, trusting that interest rates would help grow their wealth over time. But today, those once reliable tools are no longer keeping pace with the realities of inflation and the ever-evolving economy. Interest rates on savings accounts are barely enough to keep up with the cost of living, and inflation erodes the purchasing power of cash. So, where does that leave someone looking to build long-term wealth in today's world? Enter Bitcoin, a digital asset that offers a radically different approach to saving and growing wealth. Why traditional savings accounts are losing ground in the past? The average person could expect their savings account to offer reasonable interest rates. Those rates, combined with the power of compound interest, made it a reliable way to save for the future. But today's economy looks much different. Inflation is rising, and savings accounts often offer interest rates that don't even keep up with the inflation rate, meaning that your money loses value over time. For example, let's say you put $1,000 into a savings account with a 0.5% interest rate. After a year, you'll have $1,005, a $5 gain. But if inflation is at 2%, your $1,005 is actually worth less in terms of buying power than it was a year ago. This is the problem with traditional savings accounts today. They don't grow fast enough to outpace inflation, leaving savers in a losing battle. Bitcoin, a modern store of value. Bitcoin offers a completely different approach. Instead of relying on interest rates, Bitcoin's value is driven by its finite supply and growing demand. With only 21 million Bitcoins ever to be created, Bitcoin is designed to be deflationary, its scarcity increasing its value over time. Over the past decade, Bitcoin has grown exponentially, outpacing inflation and even traditional assets like stocks and bonds. While the price can fluctuate in the short term, its long-term upward trend has made it a compelling option for those looking to build wealth. Unlike savings accounts, Bitcoin doesn't rely on a central authority like a bank to determine its value. Its decentralized nature, along with increasing global adoption, has solidified its place as a modern store of value. People who bought Bitcoin early have seen tremendous returns, and even small investments made consistently can grow significantly over time. Shifting from traditional savings to Bitcoin. So, how does someone start using Bitcoin as a savings tool? The key is to treat Bitcoin much like you would a traditional savings account, but with the added benefit of potential growth. Here's a simple plan for transitioning from traditional savings to Bitcoin. Start small. You don't need to go all in on Bitcoin to see its benefits. Start by allocating a small percentage of your savings, say 5–10%, into Bitcoin. Use dollar-cost averaging, DC. Instead of trying to time the market, set up regular Bitcoin purchases. This strategy helps smooth out the price fluctuations and ensures you're consistently adding to your savings. Store your Bitcoin securely. Once you start accumulating Bitcoin, it's important to store it in a secure wallet, preferably in cold storage or a hardware wallet, to protect it from hackers. Why Bitcoin makes sense for the long term. While Bitcoin's price can be volatile in the short term, its long-term trajectory has been consistently upward. As more institutions, companies, and individuals adopt Bitcoin, its demand continues to rise, and with only 21 million ever to exist, this creates a powerful supply and demand dynamic. Just as savings accounts used to be the go-to for long-term financial security, Bitcoin is quickly becoming the modern alternative. By investing small amounts regularly, you're positioning yourself to not only protect your wealth from inflation but potentially grow it in a way that traditional savings methods no longer can. Chapter 2. Pay yourself first. Why Bitcoin could be your best savings strategy. One of the most important lessons from personal finance is the principle of pay yourself first. This idea, championed by financial experts for generations, is all about prioritizing your future by saving and investing before you spend on anything else. Traditionally, this meant setting aside a portion of your paycheck for a savings account, retirement fund, or investments. But in the modern financial landscape, where inflation erodes the value of cash and savings accounts yield next to nothing, paying yourself first takes on a new meaning. More and more, people are turning to Bitcoin as a powerful tool for saving and growing their wealth. What does pay yourself first really mean? At its core, pay yourself first is about setting aside a portion of your income before you spend on anything else, whether that's bills, groceries, or discretionary spending. It ensures that you're always building toward your financial future, even when life's expenses pile up. For most people, this has traditionally meant putting money into a savings account or contributing to an investment portfolio. The key is making it a habit, treating your savings as a non-negotiable part of your budget. But given the challenges of today's economy, where inflation eats away at cash, many are rethinking how to apply this concept. Why Bitcoin makes sense for pay yourself first? Here's where Bitcoin comes in. Rather than putting money into a traditional savings account with low interest rates, consider allocating a portion of your income to Bitcoin. Here's why. Protection against inflation. While cash loses value over time due to inflation, Bitcoin's deflationary design gives it the potential to appreciate in value. By saving in Bitcoin, you're protecting your wealth from the eroding effects of inflation. Accessible to everyone. You don't need to be a millionaire to start saving in Bitcoin. It's easy to set aside even small amounts regularly, and those small investments can add up over time. With Bitcoin, you can buy fractions of a coin, so there's no barrier to entry. Potential for growth. Unlike cash, Bitcoin has a track record of significant long-term growth. Those who have consistently bought and held Bitcoin have often seen their investments grow far beyond what traditional savings could offer. How to implement pay yourself first with Bitcoin? To put this into action, the approach is simple. Instead of thinking of your savings in purely dollar terms, start thinking in terms of Satoshis, sats, the smallest unit of Bitcoin. Paying yourself first can mean setting aside part of each paycheck to buy Bitcoin. Here's how to do it. Set a percentage. Decide on a fixed percentage of your income that you'll allocate to Bitcoin every paycheck, whether that's 5%, 10%, or whatever feels comfortable for you. Automate the process. Just as you'd automate contributions to a retirement fund or savings account, set up automatic purchases of Bitcoin. This is where dollar cost averaging, DC, comes into play. By automating your Bitcoin buys, you take the guesswork out of timing the market and ensure you're consistently investing, regardless of price fluctuations. Treat it as a long-term investment. The key to paying yourself first is discipline. Don't be tempted to sell your Bitcoin at the first sign of volatility. Treat it as a long-term savings strategy, just like you would with a retirement account or traditional investment portfolio. The power of dollar cost averaging, DC. One of the best ways to pay yourself first with Bitcoin is through dollar cost averaging, DCA. This strategy involves buying Bitcoin at regular intervals, regardless of the price, so that over time, you smooth out the volatility. Whether Bitcoin is up or down on any given day, DCA ensures that you're consistently building your position. Here's an example. Let's say you decide to allocate $100 per month to Bitcoin. Some months, the price of Bitcoin will be higher and you'll buy less. Other months, the price will be lower and you'll buy more. But over the long run, you'll have accumulated Bitcoin at an average cost, without the stress of trying to time the market perfectly. DC takes the emotion out of investing, allowing you to steadily accumulate Bitcoin over time and focus on the long-term goal of building wealth. Making Bitcoin a habit, just like paying yourself first with traditional savings, the key to building wealth with Bitcoin is consistency. By making it a habit, automating your Bitcoin purchases and sticking to a plan, you ensure that you're always setting aside a portion of your income for your financial future. Bitcoin may be volatile in the short term, but those who have held on to it over the years have often seen their patience rewarded. By adopting the principle of pay yourself first with Bitcoin, you can build a strong foundation for long-term financial growth. Chapter 3. Compounding Wealth, Traditional Investments versus Bitcoin's Growth Potential. For years, the cornerstone of wealth building has been the power of compound interest. The idea is simple: by earning interest on your initial investment, and then earning interest on that interest, your money grows exponentially over time. This concept is the bedrock of traditional investments like stocks, bonds, and retirement funds. But what if there's another way to achieve even greater growth? One that goes beyond the slow, steady climb of traditional investments. Bitcoin, with its rapid appreciation and unique characteristics, offers a different path to compounding wealth. In this chapter, we'll explore how Bitcoin's growth potential compares to the classic methods of compounding and why it could be the key to supercharging your financial future. The power of compound interest. Albert Einstein famously called compound interest the eighth wonder of the world. The principle is straightforward. By reinvesting the returns from your investment, you allow your money to grow on itself, accelerating your wealth over time. Let's break it down with a simple example. If you invest $1,000 at an annual interest rate of 5%, after 1 year, you'll have $1,050. In the second year, that $1,050 will earn interest, bringing your total to $1,102.50. Each year, your money grows a little faster, thanks to the power of compounding. Over time, that initial $1,000 can grow into a significant sum without you doing anything but leaving it invested. Traditionally, this has been the approach used in stocks, bonds, and other investment vehicles. And while it's still a valuable strategy, Bitcoin offers something different. Bitcoin's growth potential, a new way to compound. While Bitcoin doesn't pay interest in the traditional sense, its explosive growth has made it one of the most attractive assets for long-term investors. In the last decade, Bitcoin's value has far outpaced traditional investments, offering exponential returns to those who have held onto it through the ups and downs. Here's the key difference. Traditional compound interest grows steadily over time, while Bitcoin's growth has been much more dynamic, with periods of rapid appreciation. While it's important to acknowledge Bitcoin's volatility, its long-term trajectory has shown that even small investments can grow into significant wealth. For example, consider this. If you had invested $1,000 into Bitcoin in 2011, that investment could be worth millions today. While past performance doesn't guarantee future results, Bitcoin's fixed supply and growing demand make it a unique asset with the potential for outsized returns. Balancing traditional investments with Bitcoin. Of course, not everyone is comfortable with Bitcoin's volatility, and that's where a balanced approach comes in. Instead of choosing between traditional investments and Bitcoin, why not use both? By diversifying your portfolio, you can take advantage of the steady, reliable growth of traditional investments while also benefiting from Bitcoin's potential for explosive returns. A common approach is to allocate a portion of your investment portfolio to Bitcoin, say 5% to 10%, while keeping the rest in traditional assets like stocks, bonds, or index funds. This way, you're not putting all your eggs in one basket, but you're also not missing out on Bitcoin's unique growth potential. Compounding with Bitcoin. A case study. Let's take a look at a hypothetical example of how compounding wealth with Bitcoin might work over time. Suppose you decide to invest $100 per month into Bitcoin using a dollar cost averaging (DC) strategy. Over the years, as Bitcoin's value rises, the Bitcoin you've accumulated grows exponentially in value, even though your initial investments were relatively small. Here's how it might play out. In year 1, you invest $1,200 into Bitcoin. By year 5, if Bitcoin appreciates at an annual rate of 30%, your Bitcoin holdings could be worth over $6,000. By year 10, assuming the same rate of growth, your Bitcoin could be worth more than $30,000. This example illustrates the power of compounding with Bitcoin's potential for growth. While traditional investments compound through interest, Bitcoin compounds through appreciation, offering a new and exciting way to build wealth over time. The role of patience in compounding Bitcoin. Just like with traditional compounding, patience is key when it comes to Bitcoin. Bitcoin's price can be volatile in the short term, but those who have held on to it over the years have often seen their patience rewarded. By consistently adding to your Bitcoin holdings and giving it time to grow, you allow the natural process of compounding to take effect. Remember, the goal isn't to get rich overnight. It's to build sustainable, long-term wealth. And in today's world, Bitcoin offers a powerful tool to help you do just that. Chapter 4. Borrowing against Bitcoin. Using your assets without selling them. One of the most revolutionary aspects of Bitcoin is the ability to use it as collateral for loans. In traditional finance, accessing loans often involves jumping through hoops, whether that's proving your income, providing credit history, or securing your loan with physical assets like real estate or a vehicle. But with Bitcoin, borrowing is simpler, faster, and most importantly, it allows you to keep your Bitcoin growing in value while gaining access to liquidity. In this chapter, we'll explore how borrowing against Bitcoin works, why it can be a powerful financial tool, and the strategies for using it wisely without overleveraging. How Bitcoin-backed loans work. Bitcoin-backed loans allow you to borrow money by using your Bitcoin as collateral. The process is straightforward. You deposit your Bitcoin with a service provider, and in return, you receive a loan in dollars or other fiat currency. The value of your loan is typically based on a percentage of the value of the Bitcoin you've put up as collateral, often around 50%. What makes this arrangement unique is that you don't have to sell your Bitcoin to access cash. Instead, your Bitcoin remains in your possession, in a secure custodian wallet, and once you pay back the loan, your Bitcoin is released back to you. This means that even as you access liquidity, you're still holding onto your Bitcoin, allowing it to appreciate over time. Why borrow against Bitcoin? The biggest advantage of Bitcoin-backed loans is that you can get the cash you need without selling your Bitcoin, which means you avoid triggering a taxable event, such as capital gains taxes, while still maintaining ownership of your Bitcoin as it grows in value. Here are a few reasons why borrowing against Bitcoin makes sense. Access to liquidity. You can use the borrowed funds for anything, whether it's buying a house, making a large purchase, or investing in other opportunities. Preserving long-term growth. Bitcoin's price is expected to rise in the long term. By borrowing against it instead of selling it, you allow your Bitcoin to continue appreciating while getting the cash you need today. Avoiding capital gains taxes. Selling Bitcoin typically results in a taxable event, where you may owe capital gains taxes on any profit made. By borrowing against your Bitcoin, you can avoid triggering these taxes while still getting access to funds. The risks of overleveraging while borrowing against Bitcoin can be a great tool. It's important to be cautious about overleveraging. Bitcoin's price can be volatile, and if its value drops below a certain threshold, called the liquidation price, you could be required to add more collateral or risk having your Bitcoin sold to repay the loan. To mitigate these risks, it's crucial to borrow responsibly. Here are some strategies for avoiding overleveraging. Borrow less than you can. Instead of borrowing the maximum allowed, consider borrowing a smaller percentage of your Bitcoin's value. This provides a cushion in case Bitcoin's price drops. Monitor your loan-to-value (LTV) ratio. Keep an eye on your loan-to-value ratio, which represents how much of your loan is backed by your collateral. If Bitcoin's price falls and your LTV ratio rises too high, you may need to add more Bitcoin as collateral to avoid liquidation. Diversify your collateral. If possible, consider using other assets as collateral alongside Bitcoin, or hold a diverse portfolio to reduce risk. Using Bitcoin-backed loans for real estate. One of the most popular uses of Bitcoin-backed loans is in real estate. Many investors are using their Bitcoin holdings to secure loans that allow them to make down payments or even purchase entire properties. This strategy has several advantages. Using Bitcoin to generate income. Instead of selling Bitcoin to purchase real estate, you can use a loan to secure a property, which can generate rental income. The Bitcoin you've used as collateral continues to appreciate, while the rental income can cover the loan payments. Building a diverse portfolio. Real estate is a tangible asset that provides stability, while Bitcoin offers growth potential. By using both together, you're creating a diverse portfolio that benefits from the strengths of each asset class. The flexibility of Bitcoin-backed loans. One of the most appealing aspects of Bitcoin-backed loans is their flexibility. Unlike traditional loans, which often come with strict terms and conditions, Bitcoin-backed loans can be more lenient. Many services allow you to repay the loan early without penalties or to adjust the loan terms as needed. Additionally, some platforms offer the ability to use a portion of your loan to buy more Bitcoin. This strategy, often referred to as rehypothecation, allows you to leverage your Bitcoin holdings even further, though it does come with added risk. a tool for the long-term Bitcoin holder. Bitcoin-backed loans are an excellent tool for those who believe in Bitcoin's long-term potential. By borrowing against your Bitcoin, you can access the funds you need today without selling your Bitcoin, allowing you to preserve your long-term wealth-building strategy. As Bitcoin continues to appreciate, more people are realizing the power of this approach. It's a way to use your assets without giving them up, enabling you to take advantage of new opportunities while staying true to your long-term vision of wealth building with Bitcoin. Chapter 5: Real Estate and Bitcoin: Building a Portfolio for the Future. For many people, real estate has long been considered a cornerstone of wealth building. Owning property provides stability, rental income, and the potential for long-term appreciation. Meanwhile, Bitcoin represents a new frontier in wealth creation, offering significant growth potential with its limited supply and increasing global adoption. But what if you didn't have to choose between the two? In today's world, savvy investors are combining the tried-and-true stability of real estate with the explosive potential of Bitcoin, creating a powerful, diversified portfolio that benefits from both asset classes. In this chapter, we'll explore how you can build a strong financial future by investing in both real estate and Bitcoin, and how these assets can complement each other to create lasting wealth. The case for real estate has always been a reliable investment. Property values tend to rise over time, and in many markets, rental income can cover expenses while offering a steady cash flow. Here are some key benefits of investing in real estate. Stability. Real estate is a tangible asset. No matter what happens to the market, you still own physical property that retains inherent value. Cash flow. By renting out property, you can generate passive income that covers your mortgage, maintenance costs, and even puts extra money in your pocket each month. Appreciation. Over time, real estate tends to appreciate in value, offering long-term growth. In certain markets, property values can rise significantly, adding to your overall wealth. But while real estate is stable, it often lacks the rapid growth potential seen in assets like Bitcoin. That's where the combination of the two can create a balanced and powerful investment strategy. Bitcoin, a high-growth complement to real estate. Bitcoin offers something that real estate can't: rapid appreciation. Over the past decade, Bitcoin's price has risen dramatically, far outpacing the average returns of real estate investments. While Bitcoin is more volatile than real estate, its long-term growth potential makes it an attractive addition to a portfolio that already includes property. By combining Bitcoin's growth potential with real estate stability, you can create a diversified investment strategy that balances both risk and reward. Here's how the two can complement each other. Growth versus stability. Bitcoin offers high growth, while real estate provides stability. Together, they form a balanced portfolio that can weather market fluctuations. Leveraging Bitcoin for real estate. You can use Bitcoin-backed loans to fund real estate purchases without selling your Bitcoin. This allows you to keep your Bitcoin invested while gaining the benefits of real estate ownership. Income generation. Real estate provides regular income through rent, while Bitcoin offers potential capital gains. This dual strategy can create multiple streams of income and growth. How to combine Bitcoin and real estate. One of the most effective ways to combine Bitcoin and real estate is by using Bitcoin as collateral for loans that allow you to purchase property. This strategy gives you the best of both worlds. You can invest in real estate without selling your Bitcoin, ensuring that both assets continue to grow in value. Here's an example of how this strategy might work. Leverage your Bitcoin. Use a Bitcoin-backed loan to cover the down payment or even the full purchase price of a property. This way, you're not forced to sell your Bitcoin, allowing it to continue appreciating while you acquire real estate. Generate rental income. Once you own the property, rent it out to generate passive income. The rental income can be used to cover the mortgage, property maintenance, and even the loan repayments for the Bitcoin-backed loan. Hold both assets. Over time, both your real estate and your Bitcoin can appreciate in value, building long-term wealth. The rental income generated by your property provides stability, while your Bitcoin continues to grow. Real-life example: building a portfolio. Imagine you own $100,000 worth of Bitcoin and you want to buy a $300,000 property. Instead of selling your Bitcoin, you take out a Bitcoin-backed loan for $100,000 to cover the down payment. You finance the rest of the property with a mortgage. Now you own a property that can generate rental income, and your Bitcoin is still growing in value. If Bitcoin appreciates, your loan-to-value ratio decreases, meaning you could even take out additional loans in the future without having to sell your Bitcoin. This strategy allows you to build a portfolio that includes both high-growth assets, Bitcoin, and stable, income-generating assets, real estate, providing the best of both worlds. Diversifying for the future. By diversifying between Bitcoin and real estate, you're setting yourself up for long-term success. Real estate offers cash flow and stability, while Bitcoin provides unmatched growth potential. Together, these assets create a powerful wealth-building strategy that can help you achieve financial independence. As Bitcoin continues to mature and more financial tools become available, the opportunities to combine it with traditional investments like real estate will only increase. Whether you're new to investing or a seasoned pro, this strategy of leveraging Bitcoin for real estate could be your key to building lasting wealth. Conclusion: building wealth in a new era. The path to financial independence has always been about finding the right balance between risk and reward, growth and stability. For many years, that balance was found in savings accounts, stocks, bonds, and real estate. These are still powerful tools for building wealth, but with the rise of Bitcoin and other digital assets, we now have access to new opportunities that weren't available to previous generations. Throughout this book, we've explored how to combine the foundational principles of personal finance with the modern power of Bitcoin. By paying yourself first, leveraging the power of compounding, and using Bitcoin as collateral to build a real estate portfolio, you can create a powerful wealth-building strategy that balances traditional wisdom with cutting-edge innovation. The key to long-term success is consistency and patience. Wealth isn't built overnight. It's the result of steady, disciplined efforts over time. And in today's world, where both real estate and Bitcoin offer unique advantages, you can build a diversified portfolio that maximizes your potential for growth while providing stability along the way. The future of wealth building is bright, and you're in the driver's seat. With the strategies outlined in this video, you have the tools to navigate this new financial landscape with confidence, knowing that your investments in both real estate and Bitcoin can help you achieve the financial freedom you deserve.